Alternative is in fashion for a couple of reasons. One, it's in fashion because people really are looking for yield that they can't get from traditional asset classes. Two, they're looking for non-correlated groups. They're looking for groups that will protect them in the event of a big downdraft. Which are you seeing more interest in right now?
Oh, it's all about yield. And so what happens is that because everyone's seeking yield, and because like if you have this classic 60-40 portfolio, which is sort of the traditional portfolio, yes, you can get the dividends on the equities, but the bonds is where the problem is. You've got, say, 40% or 50% in bonds. They're paying 2.5% on which you're paying tax. And so people say, that's not enough for me to achieve my 6 or 7% return. So they're reaching and reaching for yield. So your two choices are, you can just buy more equities that pay dividends, but then you have to suffer the wave of that volatility, or you can go into these other asset classes that have always provided yield, like real estate, which are, whether it's debt or equity, and other types of real assets, which are out there to provide yield.
I find it interesting. A lot of portfolio managers still talk about that 60-40, and I think we both know it's not a real 60-40 anymore. Nobody has 40% in traditional conservative government or even investment grade bonds. When we talk about the 40, it's got very equity-like stuff in there now. Lots of high yield in there because there's no other way to get that. So are people even, aren't most people, even senior citizens, more like 80-20 these days when we're talking classic?
Right, and the thing is they don't really realize it because it's classified as fixed income. But to your point, if you have high yield debt in there, it's fixed income. They owe you a coupon. They have to pay you every month or every quarter, but you're taking equity risk to get it. And so that you have to say in a low rate environment, if I'm getting more than 2.5, what kind of risk am I actually taking?
Right.
And so at the banks, they have to figure out a way because they have very few arrows in the quiver. They have to say, well, from the arrows I have, which are the ones that can satisfy this? And because you can't be 100% in equities, they have to go out a little bit on the risk scale to get the kind of yield that you want to achieve.
So let's talk then about interest rates, because there is rate risk. Real estate, for instance, might suffer as we see rates going back up. Certainly a lot of fixed income product suffers when rates start to rise. What do you do about that?
Yeah, we look a lot at the sort of the spread. Let's use real estate as an example because that's a classic alternative investment. So let's say you have apartment buildings or the rent you're collecting on plazas or something like that. You would think that, okay, well, if interest rates were to go up, that means that the cap rate goes up, which means the value of your real estate goes down, and there's a lot of moving parts, and you think, oh, I could lose money here. It also is more expensive to have a mortgage. The thing that we see, though, is that the spread between cap rates and interest rates is the largest that it's ever been. Why? Because frankly, if I'm going to own any risky asset, and that just means an asset that isn't risk-free, then I have to get paid for it. And I don't care that interest rates are at 0. I need to get paid 3 or 4% in order to hold them. And so I think what you'll see that as interest rates rise, and they don't tend to rise in 1s and 2s, they rise at 25 basis points at a time, 1/4%.
Right.
I think that you're going to see that real estate is still going to maintain its value and continue to pay, but you have to diversify yourself as with any asset.
How much do you play? I mean, we listed, hedge funds. You can get those publicly now if you buy the traded ones.
That's right.
REITs obviously can be public vehicles. How much of this is very highly liquid stuff that you invest in, and how much of it is quite illiquid and sort of for a year or two that you're locked up?
Right. So let's study liquidity on 2 levels, because like if you buy, say, a publicly traded mortgage fund, you can buy and sell that any day you want. I mean, subject to the volume being there to get in and get out for larger numbers.
Yeah.
The question is also about the underlying, like how liquid are the mortgages or how liquid is the real estate. The problem with going the public route for alternatives, and by the way, many people don't have a choice, so that's the best they're going to get. The problem with that is that you're taking the volatility of the market, so if the market goes up or down, you're going to go up or down. And also a lot of income producing publicly traded alternatives trade at big discounts to what they are worth.
Right.
And the problem is that you can wait forever and it'll never trade at what it's worth, which means that if you buy it at the beginning, you might end up selling it at a discount by no fault of your own or even the manager's.
Okay, we better talk soon about some very specific names. We mentioned timber, for instance. How are you investing in timber? You've got 10 seconds.
Yeah, the only way to invest through timber these days is cut down the trees in your backyard or invest with one of these large producers like Manulife across the world.